What is the balance of trade and international economics? Imagine a country as a big marketplace where goods and services are constantly bought and sold across borders. Now, think about how much money flows in and out from these transactions. That's what the balance of trade is all about. It's a simple calculation. Subtract the total value of a country's imports from the total value of its exports over a certain period. If the exports are more than the imports, the country has a trade surplus. If the imports are more than the exports, it has a trade deficit. Exports are goods and services a country sells to other countries. Imports are what it buys from abroad. When a country exports more than it imports, it earns more money from foreign buyers than it spends on foreign goods. This can boost the country's income and sometimes lead to more investments. On the other hand, if a country imports more than it exports, it spends more money on foreign goods than it earns from selling its own. This often means the country is borrowing money or attracting foreign investments to cover the gap. The balance of trade is a key part of a country's overall economic health. It's part of the larger picture called the current account, which also includes things like income from investments and transfers. Several factors influence the trade balance. For example, if a country's currency becomes more valuable, its exports can become more expensive for other countries, leading to fewer sales abroad. Conversely, cheaper imports might flood the market, increasing the trade deficit. Consumer demand also plays a role. If people want more foreign goods, imports go up. The competitiveness of domestic industries matters too. If local products are high quality and affordable, exports tend to rise. Trade policies, such as tariffs or trade agreements, can also impact the balance. For instance, imposing tariffs on imports might reduce foreign goods entering the country, helping to improve the trade balance. Economic cycles influence the trade balance as well. During a recession, people and businesses buy fewer foreign goods, which can improve the trade deficit. Conversely, during times of economic growth, imports often increase as consumers spend more. It's important to understand that neither a trade surplus nor a trade deficit is automatically good or bad. A trade surplus might mean a country is very competitive, but it can also lead to trade tensions. A trade deficit might signal strong domestic demand, but it can also mean the country is relying heavily on foreign borrowing. In terms of imports, which are the goods and services bought from other countries, the trade balance shows whether a country is a net buyer or seller in the global market. If imports are high compared to exports, the country has a trade deficit, which can reflect a strong domestic economy but also potential challenges for local producers. Overall, the balance of trade helps us see how a country interacts economically with the rest of the world. It influences exchange rates, employment levels, and even government policies. Keeping an eye on it helps policymakers make decisions to support economic stability and growth.